Good morning, good afternoon, and good evening, everyone, and welcome to Demystifying Angel Investing. My name is Colin Mahan, and I'm a director of programs at the NASDAQ Entrepreneurial Center. And for those of you who may not know, the NASDAQ Center is a nonprofit that's building a better path for entrepreneurs worldwide by improving inclusion, access, and knowledge in entrepreneurship. As you're going to see in the chat in just a moment, the NASDAQ Center provides programs, resources, and exceptional mentorship to entrepreneurs across all races, industries, and geographies. So check out those links and resources in the chat. Now, I've got a couple of housekeeping items before we get started. Firstly, let us know where you're dialing in from in the chat. I'm in San Francisco. Secondly, we're going to open up for live Q&A near the end of this session, so please submit those questions for us in the Q&A function at the bottom of your screen. Throughout this conversation, we're going to try our best to get to them all. Now, none of what we do here at the center would be possible without all the amazing support from our sponsors, including NASDAQ, Lehigh University, BMO, Airbnb, KPMG, Wilson Sonsini, BPM, and HubSpot for startups. We're humbled by their contributions and hope you're grateful too. Before we get started, I'm going to launch a few polls to get a temperature gauge on how everyone's doing today. The first one is, how are you feeling about your business right now? Are you optimistic? Feeling a little anxiety? Let us know. We use these poll questions to help fuel the wellness and additional support mechanisms we provide for you, the entrepreneurs at the center. Right, looks like optimism is in the lead on a Friday. Love to see that. So there's a little bit of anxiety in the audience, but hopefully this conversation will help alleviate some of that. The second poll I'm going to launch is, what's keeping you up at night? We also use this to guide the program pillars that we're going to be chasing after in the next couple of months. So let us know. All right, let's see where we're coming in from. San Francisco, hello, welcome. Tennessee, great. Berkeley, Russian Hill, awesome. Florida, a lot of West Coast. All right, hello from Virginia. I'm going to end this poll and share those results. Looks like finance is at the top of the key, and you're in for a treat because that's our topic of discussion today. So without any further delay, please join me in giving a warm welcome to our special guest. David Wu is a partner at Mayron, an independent board director, an investor, a musician, and an ex-Mississippi rafter. David, welcome.
Thanks for having me. Great to
So stoked to have you for
guys.
this conversation. So stoked. So David, just to start us off, you have an amazing story. So can you tell us a little bit about your background and your journey to where you are today?
Sure. Going all the way back, my dad was a serial entrepreneur in the OG Silicon Valley. And so we moved to the Bay Area when I was 1 year old. And my mom's sort of a hippie artist. And so I've always been blessed with left, right brain infighting my whole life, probably similar to a lot of people in this room. But kind of believing that anything's possible, if you put your mind to it. I started off my career very much a tech and a product guy for many years. I was a product manager and a computer scientist. And alongside of that, I was playing music a lot of the way. It's always been a passion of mine, playing music. And at one point, we were playing 200 or 300 shows a year as a bass player and touring the country. So I quit my day job and I was a musician for about 3-4 years full time. Ironically, I learned most of my business sense in the back of a van, balancing small red finance numbers in QuickBooks, and certainly learned a lot about collaboration and patience and grit. And so I attribute a lot of my learnings back to my music career. But at some point, it became a better hobby than a job. This is kind of before the internet and before cell phones. And so came back to the Bay Area and spent the next 15 years as an entrepreneur and had one of the few dot-com survivors that made it up the bubble, down the bubble, and held on for dear life, and finally had a nice exit where we sold it to Intuit. And it was called Homestead. It was one of the first build your own website companies, kind of like the Angel Fires and GeoCities and Tripods in the old days. At Intuit, I ended up running a lot of the SaaS businesses and helping Intuit go from being a shrink wrapped company that was selling discs at Costco to being an online company. But it was great to be at a big company. I kind of advise any entrepreneur should work at a big company at least once. Most exits end up being through M&A and not necessarily as an IPO. And in either case, you end up becoming a big company. So understanding how a big company works, I often say it's similar to being, everyone should work at a restaurant once as a busboy or as a waiter, because you don't understand what that's like until you've done it. But also I missed early stage in entrepreneur, so I started doing a lot of angel investing along the sides of that, and fell in love with that, and kind of had my last career as a venture capitalist. I've been a venture capitalist now for 12 years, 10 years as a partner and at Mavron that does early stage consumer investing. And then the last couple of years I've kind of semi-retired, but I still do a lot of board work, a lot of nonprofit work, and spend my time trying to help companies.
I love that. And so to dial into our conversation topic today, the angel side of things, a lot of our founders ask how to get in front of angels, like just in general. So do you have any advice there?
So there's similarities and differences between venture capital and angel investing. And the similarities are, you're still generally raising money from people you don't know. And I often coach entrepreneurs that, not everyone has access or has the right networks, but almost all the companies that I know find a way to raise money from somebody they know before they're able to break through and raise money from somebody they don't know. And that's a big line in the sand, because, generally you can raise money from somebody who's, a rich uncle or somebody you met on the street that you've been friends with for years, that is going to pay it forward or invest in you based on the relationship, before you're able to show enough traction or have a strong enough story or have enough history that you can raise money from somebody that is a semi-professional or professional investor. So that's one big thing that's very similar. Now that's kind of where it stops. What I would say is the big difference between an angel investor and a venture capitalist is venture capitalists are generally investing other people's money. So they're spending a lot of time justifying every move they make and having their own strategy that they have to go out and pitch, just like you guys are pitching that are on the founder side, to their institutional investors and their LPs, and explain to them, we're going to take your money and use this strategy to find companies and invest in companies to make you money. And that adds a lot of constraint around what they can and can't do. Whereas an angel investor is generally investing their own money, which means it can really run the gamut in terms of why they're investing, how they're investing, and what they think about it. And so I think that's the fundamental difference. In general, it's not always true, but in general, more angels write smaller checks than venture capitalists. I know a few angels that are tremendously wealthy and they can write multi-million-dollar checks, but they're sort of the exception. So when you're doing an angel investment, oftentimes you're kind of ham and egging it a little piece at a time. So you may be raising a seed or a pre-seed that's a few $1,000,000, and instead of a single entity fighting to get that piece, you're kind of getting a syndicate of 1, 2, 3, 10, 20, 30, 50 checks to make that happen. And there are a lot of structures that can make that easier and can make that harder.
Yep. So to double click into that deal structure lane, we get a lot of questions around how angel deal structures differ from the traditional route.
So in a venture capital fund, it usually is invested out of the fund and in a single entity, maybe a couple entities, because they have some structure around that. In an angel investment, there's usually some form of syndicate. And in the simplest form, in terms of structure, but adds a lot of back and forth complexity, everyone's just writing an individual check and it's going into the cap table. And so I see a lot of companies that on their earlier rounds will have, starts friends and family round and then goes to kind of an angel round, and it's 20, 30 checks of $25,000. There's a lot of angels where the sweet spot is sort of a $25,000 check. So you can imagine it may take several bites of that to fill up a round. There are some angel groups that will syndicate and do what's called an SPV, or special purpose vehicle. And that allows this group of individuals to put it all into one entity. And it's still, sort of like when one person buys all the tickets to go to a concert and then Venmos all their friends. It's a single purchase, but you have 8 friends collecting money. That's what an SPV is. And that's what generally an LLC is the way to do that. And that special purpose vehicle is deal by deal. So they don't roll over to multiple funds, but that happens a lot. If you raise money from what's called an angel syndicate, one of the big angel syndicates in the Bay Area is called the Band Angels. It was one of the first ones. That's actually where Nicola and I used to work together. At the Band Angels, generally the band prefers to do a syndicate. And to do it through a single entity. It's easier to keep track of. And so the entrepreneurs generally prefer that as well, but it's not always logistically possible. And then when you actually look at the terms or the actual underlying structure, just like a venture investment, it could be a equity round, a series seed or a series, pre-seed, or it could be a form of debt, like a convertible note, where they're investing in a piece of debt with some kind of parameters around it, maybe some benefits, a discount to the next round, or a cap or ceiling on the most it could be valued, but it will convert over to equity at some point in time. And then the last one is a safe note, which is basically the same thing as convertible debt, but it has some perks. And it was a kind of a drafted version of that was written by Y Combinator many years ago. And a lot of people have adopted that. So it's sort of a standardized version of a convertible note.
And I've heard mixed feelings from angels on safe notes. What's your position on them?
You know, everyone has their own opinion. In general, safe notes are almost always a little more entrepreneur favorable versus a convertible note. And so most people have pushed towards standardized safe notes. When you talk about safe notes and equity, I would say, fundamentally, there's kind of two kinds of investors. There's momentum investors and there are value investors. And there's also one of the biggest things in investing is there's a lot of macro cycle. We're heading towards a down cycle right now, or we're deep in the down cycle, depending on what you believe. But we're definitely 24 doesn't feel at all like 22. And when there's a lot of FOMO and things are moving really fast, the notes in general don't protect a founder's downside very well, but they protect the upside quite a bit. But they're very simple and they're very standard, and you can be drafted really quickly, and they require very little legal fees or legal intervention. And so when things are going gangbusters, everybody kind of is okay with the note. Even the VCs that say I never do a note are kind of okay with the note. And the angel syndicates hate the note because they are, in general, Keiretsu, Band Angels, all these angel syndicates I talk about, they're generally older ex-operators, and they're a little bit jaded because they've been through several cycles. So they generally don't like a note. They like an equity because in a lot of ways, a note saying, we don't know how much this is worth, so we're going to kick the can down the road. We're just going to invest in debt. And later on, when you raise your next round, they're going to price the company and we're going to get some kicker on top of that, right? And so like a convertible notes, typically this has a $8 million cap and a 20% discount to the following round, which means I don't know how much it's worth, but I want it to be 20% better than the next guy, the person who really does know, or I want it to be no more than blank. Now, in the down times, that could be priced at $2 million and the entrepreneur takes a bloodbath. But I would say, in a lot of ways, the structure doesn't matter to the entrepreneur that much at this pre-seed seed stage. If you're lucky enough that you have a lot of demand and you're oversubscribed, you're kind of in that 0.1 percentile, and you can dictate the terms you want. You can think through, are you about your risk profile and your legal fees, and are you protecting the downside or the upside? But in most cases, you're trying to assemble a syndicate and it's really difficult. I would look at the most important anchors of that syndicate and the larger checks in that syndicate, and the market will set the price. They'll tell you, I want this structure. And what I would say is all these structures are fine.
Yeah, awesome. So when it comes to reaching out, what are some common pitfalls and mistakes that entrepreneurs make when reaching out to investors in general and then also angels, and how can they avoid them?
It's tricky because there's a real cold start issue, which is the reason that a lot of the people in this room have to do cold outreach is because you don't have the network or the connectivity yet. And that's just the truth. At the same time, the opposite is true as well, which is, I've been at Maverick around 13 years now, and we do take some cold outreach, but I don't think we've ever funded one in 13 years. And so that's a big tell. And it's so much easier, especially on an early stage company, to underwrite a person based on the warm intro than it is to do the work of, some investors really overweight, am I investing in a person and a team, or am I investing in an idea and a product? And I would say the earlier you go, much more common is you're investing in a person and a team, which means either you're just doing this for fun and you're going to burn through money really quickly and you're just throwing money around, or you're going to do the work and figure out how good is this team. And the advantage of a warm intro is you have a huge head start, which is the person who introed it to you gives you a lot of signal around how well, just like when you're interviewing a C-suite exec on your team. If a friend of yours says, this is the best person I've ever worked with, that's about as strong a signal as you're going to get, especially if they're a good friend that you trust. Even better if that friend has recommended 27 other execs to you and you know how good they were. If you get a blind intro, it's really hard. And so generally that goes into, I can't deal with this right now pile. And so I would try really hard to figure out what is it going to take for you or to add someone on your team that can break into this network of finding ways to expand your network. The best founders, or either themselves or someone on their team, becomes a professional network, which is you are always meeting people. You never eat lunch alone, and you're always asking them, the people you meet, who are the best people you know, and expand that network. So I would encourage anything you can do to find the warm intro and kind of figure out how do you get to the right people. The other mistake that I see people making on this kind of top of funnel thing is people tend to shotgun and think that all angels and all VCs think alike, or could be prospective investors. And I don't think the shotgun strategy ever works. I think you kind of have to do the work to figure out how to shoot more of a rifle. And the way to do that, there's a lot of content on the web. You can peruse through AngelList and through a Crunchbase and find friends and figure out who has invested in stuff that is similar to why they should invest in you. What are the characteristics and what is the frequency of these different people, even if you don't know them, make investments, and curate it down to a list of people that not only are good prospects for you, but also that you've done the homework. Just like if you're going to interview at a job, you can talk to their portfolio. You can present in their context why you're the perfect investment, not the perfect investment in general, but the perfect investment for them.
Super helpful. And to dive a little bit further into the portfolio comment that you made, would you suggest, if founders don't have an entry point to the individual, to look up the portfolio companies that they've invested in and try to create relationships with the founders that they've already invested in?
Yes. As a VC, one of my advantages is that I have a better hit rate than when I was an entrepreneur at doing a cold outreach to somebody and getting a response. And I still get ghosted a lot. Even people that are like, we'll get back to you, that happens a lot. And so as a venture capitalist, we spend a lot of time trying to figure out how to get a hold of somebody we want to get a hold of and what's the bridge between us and them. We were just in a discussion at dinner the other night that the 6 degrees of separation seems to not really be the case anymore. The world is a lot flatter than you might think, and there's definitely some people that know a lot of people, and you just got to figure out what those paths are. And so if you can start adding people to your network that can be the bridge from wherever your network is to the vast expanse of people that you need to connect it to, I'd spend a lot of time doing that. LinkedIn is some people say it's dead, but it's actually a pretty powerful tool to start. And you kind of want to know how are you going to almost reverse engineer. These are the people I'm trying to get to. How would I get to them? Not only get to them, but get to them with the largest endorsement, or get to them with the largest signal. So when they get it, they're going to want to respond. And you can kind of reverse construct that. And it's fine. How would I befriend those people? And maybe it's twice removed, and maybe I need to find a way to crash these conferences so I can find these employees at these companies that are introduced me to their leaders that were funded by these investors and kind of work backwards. But a lot of entrepreneurship is a combination of grit and working backwards from what are the eventual results you want and where am I right now? And that's just as true of getting the right interest.
And I couldn't agree more that fundraising as a sales process is super similar. So you talked a little bit about, checking as from your side of the desk, looking at the entrepreneur. So can you walk us through a typical due diligence process from an angel investor's perspective? Like, what are some of the key things that you do? What are the key things that you look at just initially?
So I mentioned this a little bit earlier, and it is different from every individual as an angel and even at VCs. But kind of when I think of my kind of almost market math, there's kind of a spectrum. Do I invest in people or do I invest in ideas? Right. And everyone wants to do both, but there's a bias one way or another. And there's another one, which is do I invest in momentum or do I invest in value? Um, um, what I would say is even amongst angels, there's a wide variety on this value momentum side. And the way I often describe it is we were hinting at a little bit earlier, but a lot of these angel syndicates are value investors. And one of the things I did when I first started angel investing, because it's a reps thing where you need to get a lot of pattern recognition, is I joined the band of angels and got really involved and went to a lot of due diligence sessions, like almost all of them. And they are the consummate value investor. Why? Because they're all ex-operators and they've all run big companies. And so what are they great at? They're great at looking at the data and looking at the company so far. And what they generally look for is they're looking for a Series A company that is going for a Series C price. That's a definition of value. And what does their diligence process look like? They are really kicking the tires on breaking down, does it have the right leadership team? What are the comps in market? What are the metrics they have in place? What are the KPIs? And what is disruptively different by the product? One heuristic that one of the persons that led the due diligence sessions at the band went, at least in the middle when I was there, try to simplify it and says they generally like to start with, is it real? Meaning this product you're describing or this insight or this idea, is it a real thing? The second one is, can they win? And the third one is, does it matter? And that's a real simple way of breaking it down is kind of those three. What I would say on the momentum side, there are a lot of angelless investors that are people that are recently very, very liquid because they sold the company for a lot of money. Maybe they're not even investing purely for monetary reasons. Maybe they're paying it forward. Maybe they're investing because they're having fun. It's a hobby. There's a lot of different reasons to invest as an angel. Whereas as a venture capitalist, you're investing professionally to make distributed money back to your LPs. As an angel, you can invest for any reason you want. On the momentum side, that's where the story matters, even in some sense, and who you are in terms of this association. Is it a cool association? Matters a little bit more on the momentum side. But I will tell you, in the down market, most momentum investors went away. In the up market, everyone seems to all of a sudden become a momentum investor. A momentum investor is a person investing in a Series seed company at a Series A price. It's kind of the other way around because there's so much FOMO that if we fund this thing and it takes off in a rocket ship, there's gonna, we're not gonna miss the next big thing.
Yeah, we saw a lot of that in 21 and 22.
We did.
How do angel investors assess the scalability and growth potential of a startup? You were talking about momentum investors. Are there any specific metrics or indicators that they look at?
A lot of being a lot of being a successful investor is kind of going through the mindset of what can go right. I'll give you an example. On my first 10 angel investments, there's a huge parallel curve. 5 eventually went to 0. Another 3 returned some capital. And to be honest, that's anywhere from $300 to slightly less than what I put in. So that's 8 of 10 investments that lost money. The 9th one was a nice, really nice return. And then the 10th one was post-base, which was over 100x return. And so on a power law curve, one company alone completely changed the return profile of those 10 investments. And if you look at it, anybody in here that wants to become an angel investor, there's been a lot of studies in this. And in general, an investor somewhere between 1 in 20 and 1 in 30 investments hits that one that is going to return their fund or be a winner. If you are world class, you're going to maybe be able to reduce that to 1 in 15. And so you look at the best investors, they're 1 in 10, 1 in 15, but 1 in 15 is pretty world class, is that grand slam home run. It's sort of like playing roulette, which is you got to play enough hands that you hit that green, and the best investors just kind of colored in a second green slot. And so they're kind of doubling their odds versus the normal roulette player. But that's the mindset. And so if you're an angel investor, I would highly recommend investing in 20. If you can afford to invest in 20, I would rather see somebody invest $5,000 in 20 companies than 3 or 4 companies, unless you're okay with just losing your money. And so that's something to think about. I think that when you think about these investors doing that, then they're looking through the lens of what can go right, which is most of these companies are not going to work and I'm going to lose my money. So you have to be really optimistic and think about what could go right. And in that, what could go right such that this is a big enough idea and a big enough chance of happening that it could return and carry the rest of the companies that aren't going to work. In general, the earlier it is, maybe there's that value investment, but generally they're going to overweight the person. And that's just how it is, because when you're early, you don't have a lot of track record. Now, if you happen to be a case where you're raising a pre-seed and you've launched a product and you're making a lot of money and you're profitable, the band of angels and Keiretsu would love to see you. There's not a lot of those companies. If you're pitching a deck or a story or an idea or an invention or an insight, you don't have that much track record to look at. So what's an investor going to do? They're going to work backwards, which is, what does success look like? And think a little bit about that market. Is this a market that's big enough to be interesting? Do you have enough of a competitive advantage in the way you think, but even more importantly, who you are, that you could be successful here? They're going to look a lot at what I call founder market fit, which is your expertise and what you've done in your career make you suited to beat everyone else that's trying to do something that you're doing. And in general, if you're going to be on the ride from where you are now to wild success, you're going to have a lot of people around you that are going to try to compete. What is it about your background that makes you better, stronger, faster, grittier, more insightful? Are you a world expert in this category, or have you been able to hire a world expert in this category? And for good or for bad, they're going to look really closely at your network, which is, are you going to have an unfair advantage on getting people on board your boat, which is world experts, advisors, board members, investors? Postmates was one of the best angel investments I ever made, but one of the biggest misses I ever missed was I saw DoorDash 3 years after Postmates. Now I decided not to do it, partially because I was in Postmates, but also because it felt like at that time they were 3 years too late. What did I miss? It was 5 GSB students. This was a race. It wasn't a technological innovation anymore. And their ability to raise $1 billion from SoftBank kind of trumped Postmates' ability to do that from Bastian, who was an immigrant from Europe. Even so, they all end up being good exits, but DoorDash had that founder market fit, which is, how do we hire the best people to run faster and raise more money?
Yeah. And, so founder market fit is a term that is growing in market, and I appreciate your insights there. But how do investors look at the market opportunity? So what do they look at when assessing market size, growth potential, competition, all of those things?
I think there are kind of 2 general categories that I break this down. There's kind of bigger, stronger, faster, which is this market already exists, and we can benchmark that market. And the other one is kind of Brave New World, which this market does not exist yet. And I think the underwriting of those 2 is quite different. And the first one, which is sort of better, stronger, faster, you look at the endpoint, which is probably public company comps, which is at the end game, what is this company going to look like if it's wildly successful? And one thing you'll see is, we only invest in consumer companies at Mavron. In a bull market, when the market macro is way up, everything kind of is compared to tech valuations, tech multiples. But when the market contracts back, then all of a sudden WeWork is actually a real estate company. It's not a tech company. And General Assembly is an education company. It's not a tech company. And you can kind of go down the list. But we're going to look at public company comps, and we're going to look at, there are some businesses that are playing in a giant category right out of the gate. There's some that are playing in a smaller category that gives you an unfair advantage expanding to adjacencies to cover a much larger category. So they're going to look at the TAM, the total addressable market, and they're going to look at how much of that do we think kind of top down you could cover, and what's your unfair advantage in the moats? Are you going to be able to sustain that and win that place? And the other thing we're going to look at is how cash efficient is this company. I think that in the boom cycle, cash is really cheap. So people kind of forget to do that. I think now people are saying, well, how cash efficient? Because, another example is one of the 8 companies I mentioned, kind of company number 7, ended up selling for $300 million. And I invested at a $5 million cap note, and I made $363 when it exited. And that's because it raised a lot of money along the way. And the earlier investors got more or less wiped out. And so I think a lot of sophisticated angel investors are going to think a lot about how cash efficient is this business. So that's another kind of axis they're going to look at. And then depending on the segment of the business, they're going to look at what are the metrics. Do I have pattern recognition around the kinds of metrics we should look for? If it's a consumer social company, what are the daily actives? What are the monthly actives? What are the 30-day churn numbers? What are the growth numbers? Is it linear growth or nonlinear growth? Are you using paid acquisition? Are you using, organic acquisition? There's kind of a set of metrics around this kind of business they're going to look at. On the other side, which is sort of this, what I was saying, brave new world, a lot of the thesis is, can this company be a market leader in a market that is very small now, but is going to become really big later on? And that's a lot different kind of underwriting. First of all, you got to be very thesis driven, which is you have a strong point of view that this is a small market that is going to become a big market. VR is a great example. There's a lot of people who do not believe in VR, and there's a lot of people that are, this is a foregone conclusion that VR is going to go from a small market to a large giant market. And if you can be a market leader in VR, that could be a money-making investment. Now, the other X factor on the small market becoming a large market factor is the timing. Timing is really, really important. I think a great investor once said, for a VC to return, kind of a fund on a small market becoming a big market, the idea has to be not only inevitable, but also imminent. And it's really hard to predict how the near future plays out. I'm pro spatial computing. I believe in VR and XR, and I spend more time than I should in VR. I still think it's hard to tell if the inflection point is 3 years away or 30 years away. And at 3 years away, you look like a genius. And at 30 years away, I might not be around when this investment makes money. And so that's really hard. I think, especially on the small market, large market, you want somebody that is going to be both somewhat visionary and an incredible storyteller, so that they can be perceived as personally, not just company, but personally a market leader, but also somebody that's gritty enough and that they're not going to run out of money. And the ancillary to being gritty enough to not run out of money is ideally their storytelling and their visionary ability to raise money. Because there's only 2 ways you don't run out of money: is you either raise more money or you spend less.
Yeah. So to double click into that storytelling lane, you mentioned founder market fit. So how can entrepreneurs craft a compelling story and a narrative that resonates with the entrepreneur? Any advice around that?
I mentioned that VAN framework. Another framework that's kind of interesting to me, and I think it's even more applicable in the down cycles, is one that somebody at Andreessen Horowitz once told me that they use, which is they start off with, is the founder special? And that's one we've talked about already. The next one is this a dumb idea? and they want yes as the answer. And then the third question is, once you dig in, does the founder have a secret? And this plays into this idea of being contrarian and being right. That's true of the investor, and that's true of the founder, which is there's been lots of times when something that really seemed like a silly idea or stupid idea, something clicked, and you realize that the founder has done enough work or they have enough experience in their past that they've unlocked a secret that everybody else has missed, and they can build a moat out of that. I think that's an interesting mindset, right? Because a lot of early stage founders kind of pitch a story that sounds great to them, but sounds like every other story. And I think the things that stick out are, you go home, maybe especially a professional investor seeing 10, 20, 30 investments. What's going to stick out? A really non-normal special founder that has a crazy background, ideally crazy successes in that background, even better that those successes are related to this, but also somebody who thinks really differently, and that it's really, really thoughtful, right? Somebody who has dissected this market and figured out that there is an opportunity that maybe that didn't exist last year because of the way the app stores are changing, or because gas stations are actually disappearing faster, that gas delivery has to happen now. What is that unique insight that you're bringing to the table? And somewhat contrarian. I think a good question for a lot of investors is, compared to everyone else that's doing this, what are your biggest, most contrarian viewpoints? Right? Because being similar to everyone else isn't going to really unlock that much alpha.
Totally. Yeah. Think about Airbnb. Everyone thought it was a joke.
Yeah. And if you look at a lot of the best investments, if you go back to the founding days, especially at that seed, pre-seed, all the investors pass because it seemed like a bad idea. You look at Roblox, you look at Airbnb. I mean, you look at all these companies, but if you go back to their earliest deck, even then there was some combination of something that makes the founders really unique. And the best founders making what I'm kind of describing as these really power law curve outcomes are really lopsided. And so when we did a lot of analysis on all of our investments and which ones drove the most returns and what were the characteristics, and the founders were almost all what I would call unapologetically non-normal, one of our core values, but also really lopsided, which is they have some incredible superpower that is in the power alley of this company, as well as some fatal flaws. And so then the real question is, can they get the people around them so they don't shoot themselves in their foot with that fatal flaws? Because those superpowers cast big shadows.
Yeah, totally. So let's say you inspire or interest the angel or investor with your story, with your deck, and you get to the negotiation process. What advice do you have for entrepreneurs on safely negotiating deal terms to make sure that they don't kill the deal, but also that they get the best outcome for them and the investor in the end?
I actually have one more comment on that last topic, and then
Yeah.
we'll come to this, which is, I think, as I mentioned, what can go right? I think almost all investors, including angel investors, not only are looking for grit, they're looking for people that overcome adversity. So I'd weave that in. If you can find
Mm.
pieces of previous examples of overcoming adversity, but they're also looking for people that are wildly, wildly ambitious. And so you never have more license to be more ambitious about what you're trying to build and what you're trying to accomplish. And a lot of early stage founders don't feel they have the right yet to be so ambitious. I think now is the time to double down, which is, I want to take over the world. Now, the way to balance that is to be self-aware enough that you're going to do that one step at a time. I think that the best investors do not want anybody who's going to boil the ocean. And if you come out and say, I'm going to build Amazon out of the gates, then you're going to spook a lot of people. But if your answer is, I'm going to do this very specific thing, but I'm not going to be done until I've taken over the whole world, that's kind of a storytelling arc that most investors are really looking for. So I encourage you guys to be really, really ambitious, but thoughtfully sequenced. Coming back to, okay, you're actually negotiating with venture capitalists, or you're negotiating with angels, and you're getting the terms together. The first thing I would say, actually, I spent a lot of time with some professional negotiation coaches and learned a lot from them. And a lot of the things I brought with me are kind of the opposite of what you often are taught, which I think is very interesting. The first one is don't bluff. I think that's just the first thing I would tell all of you guys, that there's a lot of people that are telling you, go tell everyone I'm closing term sheets next Wednesday. I have a lot of interest. I'm going to get two. Don't bluff. I can't tell you how many deals I've seen where an entrepreneur overplays their hand, and all the VCs, or a lot of the VCs, but actually a lot of the angels, compare notes. And the problem with bluffing is it puts you in a really bad position. If your bluff is called, then you really have no recourse, and so it's an existential risk. So I wouldn't bluff. The second one is try really hard not to be needy, and I think it's one of the hardest things to do. And one of the hardest things that I have CEOs that have raised hundreds of millions of dollars, and trying to coach them to not be needy, because anybody who's been in a relationship, anybody who's tried to raise money, nothing spooks somebody more than the other person coming across as needy. So I would start in your own head of, I don't need this money. And in fact, you investing me is likely to be the best thing that ever happened to you. Put it in context of the other person, which is, what are the benefits to them? Why should they invest? Not for you, but why is this, the biggest mistake they're ever going to make if they don't invest? That doesn't mean go in really cocky, or go in, thinking you have all the cards, but I would encourage you to put it in the context of the other person. Don't be needy, don't bluff. And then the last one is, do a lot of diligence on these investors. I think that a mistake a lot of people do is, both if they have tailwind and they have a lot of demand, or if they have no cards and they only have one investor, not doing the diligence. And, if the investor's a good investor, they're doing a lot of diligence on you, you should do a lot of diligence on them. And a couple things happen. One, as an investor, I really like it when somebody does diligence on me. That's very attractive. That means, one, it's likely they're really doing their homework on me. And two, it means they're really thorough. It means that these guys aren't fooling around, that this team is actually very diligent about their work and they care. And it also means when you raise money from other investors, you're going to do the work too. I think a lot of investors that have been around the block have seen that a founder will often take the easiest money and pair them up on a board or with other investors that are disaligned. And disalignment is the death of a lot of cap tables, and it's something you want to look out for. The way to diligence investors is figure out who are some of the biggest failures in the portfolio. Because the truth is, angel investors, and especially venture capitalists, have stellar reviews from their best companies. But what you really need is to understand what happens when you're doing badly, or when you hit a really big speed bump. They're not going to be aligned, but are they going to be do their best to be somewhat empathetic and find an aligned solution, or they're going to come guns blazing? I think bad investors come in a couple flavors. On one end of the spectrum is sort of the backseat driver, and the person that has all the answers and thinks that they can fly in once a month and know more than you do. Be really careful of that investor. The other end of the spectrum is sort of the passive cheerleader. Now, I'll take that 100 times more than the backseat driver, but it also does a lot of danger, because you're going to be crawling across a lot of broken glass and going through a lot of hardship. And what you really want, I think, is a supportive truth teller that's actively involved, which is somebody who's self-aware enough to know that they can't do their job better than you, as long as you're doing a good job, but is also going to hold up the mirror and saying, look, for context, this is where you're at, and these are what other companies are doing, and these are best practices, and being able to have the real, honest, tough discussion. And so I'd spend an inordinate amount of time trying to find the best investors and do the homework. And on the terms, and that's where you started, the terms are generally pretty vanilla if you have good investors. It almost doesn't matter that much. And you have to have a good legal counsel. And the good news is, all the big firms will generally do early stage seed, pre-seed, pro bono at first, because that's part of their sourcing strategy. If you can't get a lawyer for free right now, I'd look at, are you too early, or why that is, or do you not have the right network? Because it should be a lot easier to get a lawyer to do the work early on for free than it is to get an investor.
Yeah. Oh, that's great advice. We are coming up on live Q&A, but I do have a couple more questions that I want to get to before we jump into that. But if you have questions for David, please drop them in that Q&A box at the bottom of your screen. So David, you talked a lot about the founder market fit, but a lot of investors and angels look at the team. So how do they evaluate the startup's strength of the team, and what characteristics or experiences do they look for in the founder's key team members?
You know, for good or for bad, when I was a founder, and when I was an entrepreneur, I almost thought it was a flaw that investors spend so much time looking at the CEO and spend less time at the rest of the C-suite. The best investors look at both, but they still dramatically overweight the fearless leader because that's a lot of their investment. And so they're going to spend a lot of time looking at the CEO. And as I mentioned before, kind of founder market fit is what they have done in their past life going to give them a significant advantage versus anybody else building this company. I think they're going to look at signal from a couple of areas, which is resilience, which is what have you done that was really, really difficult, and did you overcome those and come out a winner? The second one is they're looking for winners. They're looking for people that whatever they did they crush it? Did they do really, really well? Were you great at sports? Were you great at speech and debate? Were you, from nothing, did you build a fast casual restaurant? Like whatever you did, the more you can spin that into overcoming hardship and building something really, really special that feels really non-normal. Were you, number two in the World Series of Poker? What is interesting about you that is really non-normal, that showcases resilience and building something great? The second one is the storytelling more than fundraising is important in the, can you get other talented people on your boat? Now, I think a lot of investors have found that great person that is brilliant, the smartest person you've ever met, and has done some really great things as a solo sport, but can't build a team. And that's a disaster. That's the company that's problematic. And so what are they looking for? They're looking for signal of who have you surrounded yourself with? And am I scratching my head saying, how did that person at that stage get these freaking people on their boat as an advisor, as a board member, as a friend, whatever it may be? That guy, that gal, they are winners. And I think we're going to look at that a lot. Another test a lot of VCs and angels do is, I'm going to find somebody in my network and throw them your way and make an introduction. And if you pull them into your field and they come back and join the team because they want to be an exec or become an advisor, that's a really positive signal. If they go, yeah, they never really followed up or didn't like him that much, that's a really negative signal. But you are looking for people that the combination of kind of 1 in a million grit winner and can weave a spell around great people, so they're magnets of great people and talent.
Sound advice. And to round us out before we jump into Q&A, so David, after you've received a check, how do you what's your advice around maintaining these relationships, leaning on them without feeling need or feeling that they're needy? So what happens after you get the check?
Best in class is sending out some kind of update on some consistent frequency. I think that the actual cadence doesn't matter. That can be monthly, weekly, quarterly. I think most commonly it's either monthly or quarterly. And that generally is, here's what's going on with the company, and here are some asks, which is, here's what you can do to help me. And I think there's always a couple that are sort of the linchpins, the most important ones for the next round of the larger investors. And I would break those out from the rest, which is manage them separately. And you got to find the right balance, which is what's a fair amount of time to spend with them that's not so distracting, that keeps them at the right elevation. And that's what I would recommend.
Yeah, it's great advice. And I think we've covered almost the entire journey of the angel investment ground. So this is amazing. We've got some live Q&A questions coming in, so we're just going to roll through those.
Great.
How much credence do you put into the financial projections at an early stage angel investment?
Personally, zero. We always joke, we're like, the only thing that is guaranteed is that that's a spreadsheet and not the truth and is wrong. But we spend a lot of time looking at the quality of thought put into that,
Mhm.
which is very interesting, right? So it's not the actual numbers on the page, but it's the quality of thought put into that. And it will give us an idea of the financial sophistication of the founder or the financial sophistication of the finance person that they were able to get on the bus. The second one is we can sort of get a sense and underwrite how conservative versus aggressive they are. And is that grounded in reality or not? And so that's a very interesting thing because on one hand, you want really ambitious numbers and they're always wrong. But you also want somebody who sort of understands that those are ambitious so they don't get in trouble, right? And so that intersection between the cost side and the revenue side and how they intertwine, that insight into what are those drivers and how they created that sensitivity is really valuable. The best investors are going to take and build their own financial model completely separate from yours, and they're going to compare the two. And then they're going to look at the points of differences and really try to understand what am I missing here, and how are you thinking differently? And the quality of those answers is what's going to matter, not the actual numbers.
Yeah, that's great advice. And um, another question here on what are your thoughts on crowdfunding? This could be a whole talk.
You know, I think we're a little bit in beggars can't be choosers right now. It's a really tough funding environment. I think that in a bear market, and in general for founders, you take the best money that you're able to get. I do think crowdfunding is generally perceived as kind of less prestigious money than angel money or even an angel syndicate or venture money. So there's going to be a question always of why were you unable to get angel money or unable to get venture money? All that said, right now, I think in a down market, I worry less about signaling and I worry more about staying alive. And so I generally take the best money you can get. I don't think very many companies right now are getting penalized for the quality of the money they've raised in the past. They're getting penalized because they ran out of money. And so, I guess, beggars can't be choosers. But crowdfunding is generally associated with a lower sophistication of your audience. Now, one thing I would say if you're crowdfunding or using one of these crowd investing platforms is if you have a product or a service that has mass appeal and you can kind of show that some of the people funding you through the crowdfunding is even better, or crowd investing are the same people that fell in love with your product, you can weave a story that it's not that is kind of the unwashed masses investing. It's that you have such a passionate community of your own customers that they want to put your money in. I think it helps the story a little bit. But as I was starting off with, I wouldn't worry right now a lot about optics. The world is rotated to a place that if you're staying alive and still building your dream in the right direction, there are a lot of companies that are staying alive but have lost the spirit of what the company stood for, right? They're bootstrapping in such a direction. They're not actually building the bridge in the right direction anymore. If you can keep building towards your North Star and are able to fund that, I wouldn't worry about signaling.
Yep, that's great advice. For pre-seed idea stage companies, how important is funding team pre-funding? I have talented and experienced people who are willing to come on board, but they want to be compensated, and it sounds like they don't have the cash. But they have senior level advisors from major tech companies onboarded. So would you leverage them in a deck or?
I would. I mean, I think there's, like I was mentioning earlier, there's as much signal from we're trying to figure out are you special and are you able to get special people on your boat? And if you can give any signal of that second one, including bringing them to a meeting or letting them be references, or if you have this killer team but you can't pay them yet and they all are on the slide deck and we'll take a call and say, yeah, as soon as things get funded, I'm on board. All that helps. And so anything you can do to strengthen the signal that you're able to punch well above your weight class on attracting talent is going to help.
Yeah. Um, So there's just thanks coming in through the chat from Ujuya. Hello. Let's see. We're coming up on time, but where can you find angels that have invested and had exits? You mentioned a little bit about this, but is there a directory like Crunchbase that gives you this info?
I mean, AngelList is pretty good. I think AngelList has become more syndicate focused in the last 5 years than it used to be, but it's pretty good. Crunchbase is okay. You know, ChatGPT is hit or miss.
I
Right?
knew
A
it was
lot of this information, a lot of this information is published out there, but not in a single corpus. And so it
yeah.
is, a version of Ask Dr. Google. And so there are people that have scraped and created their own little, you know, linked sites to do SEO to figure out like who are the best blank investors. But eventually, if you scrape enough content out there, you can kind of infer where the hotspots are. With VCs, I like a lot of times I look at the companies that are the best examples of similar companies that if we were wildly successful, we would look kind of like blank. Right. If I was building a payments company, I would look at Stripe and I would look at Plaid, I'd look at the press releases and I look at the names of the investors that were quoted in the press releases because at each round in the press release, the main investor that led that round usually gets a quote, right? So at the Series A lead investor gets a quote. So you can go back and look at all those press releases and kind of infer who were the players. Now, there's always a lot of turnover. There's a lot of, right now, when the market goes the other way, there are a lot of tourist VCs got washed out. And a lot of tourist angels that were really rich a couple years ago and sprinkled, 50, 25K checks probably stopped investing now. But there's just a lot of disparate content on the web. But Crunchbase, of course, and a lot of these things, you get better signal if you have paid access to them. So if you can find a friend that has paid access, use theirs. Same thing with AngelList, right? If you're kind of an AngelList active member, you can probably see a lot more stuff than somebody who's not logged in or somebody who's not familiar with AngelList. So go find somebody. If you can find an angel that's just going to befriend you. And another piece of advice I would give is, as you're networking, try to punch high. There's a lot of pay it forward if you could find just the right person. It's easier to find somebody that wants to help you than it is to find somebody that wants to fund you. But the step towards finding someone that wants to fund you is go keep networking and find somebody that likes you and is on your side, that's in the inside, right? If you can find one angel that's a prolific angel that's your friend, and if you can find, if you're going to want to hire a great marketing person, get the interest, to find a way to get an interest to the best marketing people out there that are not looking for a job, but you want to talk to them about, I want advice on what a great marketer looks like. I want advice on what a great angel looks like. I want advice on what a great VC looks like. That person's really easy to say yes. There's a lot of no's. You're gonna get a lot of rejection. I mean, if you're an entrepreneur, already, there's just a lot of rejection. But getting somebody that wants to give advice is a lot easier. And advice often is the key to getting out of the cold start networking problem, because the best advice is, give me 3 people that are these kinds of people to show me what good looks like, right? And not because I want their check, and not because I want them to be on my board, not because I want to hire them, but I just want to know what best in class looks like so I can calibrate. You probably get that intro, and then go talk to those people and keep doing that. And somebody along the way is going to say, I got a friend that actually wants to do this right now. I got a friend that's an angel that actually is looking for this, or I got a friend that's a marketer that used to work for me that's looking for this job. And then you're in.
Oh, amazing. Well, I was going to ask for a key takeaway, but that sounds like the best one, David. So we're at time. I really appreciate you joining us today. Wow, what a treat to have you. And I'm hoping and I am sure that everybody in the audience is appreciative of your time as well.
Great. Well, thank you for having me. I appreciate chatting with all you guys, and you got one of the toughest jobs in the world, and it just got tougher in the last couple of years. But coming from somebody that's been an investor and an entrepreneur and a musician, what they often say is that there's no job more emotionally rewarding than being an entrepreneur. And oftentimes, you guys probably know better than anyone, it's not that intellectually rewarding, because it's sort of just pounding the pavement again and again and again and again and never saying quit because you have that gene missing in your brain. But higher highs and lower lows, there's no better job than being an entrepreneur in terms of higher highs and lower lows emotionally. And you got to stay grateful through all of it.
Well, thank you, David, for that
Thanks.
last piece of advice. And for everyone on, you can join us for our upcoming programs. Thank you again for joining us all today. We look forward to welcoming you online back with us soon. Thanks again, David.
Great. And David Wu is like someone wrote there are 3 David Wus on LinkedIn. It's a somewhat common first and last name, but I think I'm the only one that has musician as well as rafter in my title. So
Yeah, there you go.
take care.
Appreciate it. Thanks again, David. And we'll see you all so soon.
Great. Take care.